The biggest risk to the United States economy was never the AI bubble. It was never China. It has always been something far more boring and far less visible. If you have been wondering why mortgage rates refuse to fall, why stocks randomly wobble every few months, the answer does not start in Washington. It starts in Tokyo. Japan has been the quiet duct tape holding the global financial system together for roughly 30 years. And that duct tape is finally starting to peel away from the wall. To understand why Japan matters so much, you have to go back to the early 1990s, when Japan's massive asset bubble burst and the economy simply stopped moving. 3 decades of no real growth, no inflation, and no wage movement. The economy hit pause and nobody could find the remote. So the Bank of Japan did what central banks always do. They cut rates to zero. Then, below zero. Then they capped long-term bond yields entirely. The Japanese government essentially superglued interest rates to the floor and left them there. And that created a massive problem for Japanese investors. If your domestic bonds pay 0%, you have 2 options: accept nothing or take your money somewhere else entirely. Japan chose option 2. They became the largest foreign holder of United States Treasuries, one of the biggest buyers of mortgage-backed securities, and the world's largest net creditor nation. Here is how the mechanics worked. A Japanese investor borrows money in yen at near zero cost, converts it into dollars, and buys United States assets that yield 4%, then pockets the gap. Danwal. This became known as the yen carry trade. And when your borrowing cost is nearly zero, you do not just buy safe assets. You buy tech stocks, real estate, and emerging market debt, anything with a pulse. At its peak, some banks estimated the yen carry trade reached into the trillions. Global markets were essentially running on Japanese liquidity for decades without most investors ever noticing. But the entire trade rested on one assumption: that Japanese yields would stay near zero forever. In 2024, the Bank of Japan ended that assumption and raised interest rates for the first time in 17 years. The market reaction was immediate. The S&P 500 dropped 6%. Japan's index fell over 12% in a single day, its worst drop since 1987. Markets were officially signaling discomfort. When Japanese yields rise, borrowing in yen becomes more expensive. Hedging currency risk becomes more expensive too. The trade that looked like free money stops looking free rather quickly. And when the math flips, the capital flows flip with it. The money that left Japan for 30 years begins returning home. That process is called repatriation, and it is one of the largest pressures in global markets today. Here is why this matters beyond Japan. For decades, Japan was not just any buyer of United States debt. They were one of the most consistent, price-insensitive buyers of long-term treasuries in existence. The Federal Reserve controls short-term rates, but 10-year, 20-year, and 30-year yields are set by supply and demand, and most people are watching the wrong lever entirely. If you want to keep understanding how these mechanisms actually work, subscribing to this channel means you will not miss the explanations that traditional financial media skips over. The United States is running trillion-dollar deficits annually. The Treasury issues enormous volumes of new debt every year just to keep operating. Someone has to absorb all of that supply consistently. If Japan steps back from buying United States debt, yields on long-term treasuries have to rise to attract replacement buyers. That is supply and demand working exactly as designed, just not in anyone's favor. And when long-term yields stay elevated, mortgage rates stay high. The Fed can cut the federal funds rate as much as it wants. But if Treasury demand weakens, the long end of the yield curve does not cooperate. The same dynamic applies to corporate borrowing. When capital was cheap in 2020 and 2021, companies issued debt at a rapid pace. Access to low-cost financing accelerated investment, deals, and valuations across the board. But when borrowing costs stay elevated, risk appetite falls. Growth slows. Capital tightens. Credit is the bloodstream of the corporate world, and when it thickens, everything downstream moves more slowly. This is the core of the story. For 30 years, the United States benefited substantially from sitting at the receiving end of the world's largest carry trade. That trade is now unwinding, quietly and gradually. Traditional financial media ignores this because it is not a loud story. Nobody trends on a cross-currency capital flow data. People want inflation headlines, AI earnings, and whatever the biggest stock did this week. The real risks in markets are rarely the ones making headlines. Those are usually already priced in. The risks that move everything, stocks, mortgages, corporate credit, are the ones sitting quietly in the background, building pressure.